Hello, and welcome back to my channel, The Behavioural Investor, your one-stop shop for all things investing and personal finance. Investing is an important aspect of personal finance, and the goal of investing is to achieve a return on investment over time. However, investing is not just about numbers, it also involves psychological factors that can influence decision-making. Behavioural finance is the study of how psychological biases can impact investment decisions and outcomes. The Behavioural Investor by Daniel Crosby is a book that provides an in-depth understanding of these psychological biases that can affect investment decisions and offers practical strategies to overcome them. This video will provide a detailed summary and analysis of the key concepts presented in the book. Daniel Crosby is a psychologist and behavioural finance expert. He's the founder of Nocturne Capital, a financial advisory firm that integrates the principles of behavioural finance into its investment philosophy. Crosby is also a popular speaker and author of several other books, including The Laws of Wealth. So, section number 1, the importance of awareness. The first key concept presented in the book is the importance of awareness. Becoming aware of the psychological biases that can impact investment decisions is the first step to overcoming them. The book provides an overview of some of the most common biases, including overconfidence bias, herd mentality, and loss aversion. Overconfidence bias is the tendency to overestimate one's own abilities and the accuracy of one's predictions. This bias can lead to excessive trading, taking on too much risk, and poor investment decisions. A worked example of overconfidence bias is an investor who believes that they are an expert in a particular industry and decides to invest a large portion of their portfolio in a single company within that industry without fully considering the risks involved. Herd mentality is the tendency to follow the crowd and make investment decisions based upon what others are doing, rather than doing independent research and analysis. This bias can lead to buying at market peaks and selling at market bottoms, as well as missed opportunities. An example of herd mentality is an investor who buys a stock simply because it is popular among their peers, without considering the fundamentals of the company themselves. And finally, loss aversion is the tendency to feel the pain of losses more acutely than the pleasure of gains. This bias can lead to holding on to losing investments for too long, or selling winning investments too soon. A worked example of loss aversion is an investor who sells a stock as soon as it shows a small loss, rather than waiting for it to potentially recover. An investor who is aware of these biases can step towards overcoming them. For example, an investor who is aware of their overconfidence bias can seek out the opinions of others and conduct thorough research before making investment decisions. An investor who is aware of herd mentality can focus on their own goals and objectives rather than being swayed by the opinions of others. And an investor who is aware of their loss aversion bias can set clear exit strategies and stick to them, rather than letting emotions cloud their judgment. Section number 2, the power of storytelling. The second key concept presented in the book is the power of storytelling. Humans are wired to respond to stories, and stories can have a powerful impact on investment decisions. The book explains how stories can influence how we perceive risk and opportunity and how we make investment decisions. The book explains that stories can make investment decisions more relatable and memorable. This can be helpful in understanding complex financial concepts and making informed investment decisions. However, stories can also be misleading and can lead to overconfidence bias, herd mentality, and other psychological biases, as we've already discussed. An example of the power of storytelling is where an investor who hears a compelling story about a new company that is disrupting the industry. The investor becomes convinced that this company will be the next big thing and decides to invest a significant portion of their portfolio in the company, without fully considering the risks involved. To overcome the potential negative effects of storytelling, the book suggests that investors should focus on facts and data when making investment decisions. Investors should also consider multiple sources of information and conduct their own research before making investment decisions. By doing so, investors can ensure that they are not being unduly influenced by stories and are making decisions based on comprehensive understanding of the investment opportunity. Section number 3, the impact of emotions. The third key concept presented in the book is the impact of emotions on investment decisions. The book explains that emotions such as fear, greed, and hope can impact investment decisions and lead to suboptimal outcomes. Fear is a powerful emotion that can cause investors to panic and make irrational decisions. Greed can cause investors to take on too much risk and become overconfident in their ability to make money. Hope can cause investors to hold on to losing investments for too long, in the belief that they will eventually turn around. For example, an investor who sells all of their investments during a market downturn out of fear that they will lose all of their money. Another example might be an investor who becomes overly confident in their ability to pick winning investments and takes on excessive risk, only to suffer significant losses. To overcome the impact of emotions on investment decisions, the book suggests that investors should have a clear investment plan and stick to it regardless, even in the face of market volatility. Investors should also focus on the long-term goals of their investment portfolio, rather than short-term market fluctuations. By doing so, investors can avoid being influenced by emotions and can make decisions based on a rational analysis of the investment opportunity. Section number 4. The importance of self-control. The fourth key concept presented in the book is the importance of self-control. The book explains that self-control is essential for making rational investment decisions and achieving long-term financial goals. Self-control is the ability to resist the temptation of short-term rewards in favour of long-term goals. This can be difficult in the context of investing, as short-term market fluctuations can be distracting and emotional. However, self-control is essential for making rational investment decisions and achieving your long-term financial goals. To improve self-control, the book suggests that investors should have a clear investment plan and stick to it, even in the face of market downturns. Investors should avoid checking their investment portfolio too frequently, as this can lead to emotional reactions to short-term market movements. By focusing on the long-term goals of their investment portfolio, investors can maintain self-control and make rational investment decisions. Takeaway number 5, the role of advisors. The fifth key concept presented in the book is the role of advisors. The book explains that advisors can play a valuable role in helping investors overcome psychological biases and achieve their investment goals. Advisors can provide valuable guidance and support, helping investors to overcome psychological biases and make rational investment decisions. Advisors can also provide a sense of accountability, ensuring that investors stay on track with their investment plan and do not become distracted by short-term market fluctuations. To ensure that investors are working with qualified and trustworthy advisors, the book suggests that investors should do their research and choose an advisor who has relevant experience and a good reputation. Investors should also establish clear communication with their advisor and ensure that they understand the fees and charges associated with their services. So, in conclusion, The Behavioural Investor by Daniel Crosby provides valuable insights into the psychological biases that can impact investment decisions and offers practical strategies for overcoming these biases. The book emphasises the importance of self-awareness, data-driven decision-making, and self-control, as well as the value of working with a qualified and trustworthy financial advisor. The worked examples provided throughout the book illustrate the potential negative effects of psychological biases on investment decisions and highlight the importance of taking a rational and objective approach to investing. By following the strategies presented in the book, investors can improve their investment outcomes and achieve their long-term financial goals. For investors who are interested in improving their investment outcomes and overcoming psychological biases, the following next steps are recommended. Conduct a self-assessment to identify potential psychological biases and emotional triggers that may be impacting your investment decisions. Develop a comprehensive investment plan that is based on data-driven analysis and is aligned with long-term financial goals. Consider working with a qualified and trustworthy financial advisor who can provide you guidance and support in achieving investment goals. Stay informed about market trends and changes, but avoid being distracted by short-term market fluctuations. And lastly, Regularly review and adjust your investment strategies as needed to ensure they remain aligned with your long-term financial goals. Overall, the Behavioural Investor is a valuable resource for anyone who is interested in improving their investment outcomes and achieving long-term financial success. By understanding the psychological biases that can impact investment decisions and taking a rational and objective approach to investing, investors can achieve their financial goals and secure their financial future. And that's it. Thank you once again for watching. I've been the Billiards Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.